Okay, hello, my name is Dennis Shoemaker. I'm part of the research and strategy team at AEW. Today I will interview Hans Frensen, Head of Research and Strategy at AEW, about the 2019 Annual Outlook, which has been put together in a joint effort between the teams here in London and Paris. Our report, if you have not already received it, you can download it from our website. There's a version available in English, French and German, and there's also a mobile enabled access. Furthermore, we have the webcast over there as well, so let's get started. We got frequently asked the low bond yield environment. What is your outlook going forward?
Yes, well, I think this is really the most difficult question, but also, of course, the most frequently asked question, which is like, okay, our property yields have been coming down steadily over the years. They're at a historical low at the moment. What is the outlook going forward? And it's probably one of the more difficult questions. But to just address it up front, we expect that property yields will shift out by between about 50 to 95 basis points over the next 5 years. So that is the central starting point of our outlook. But if we stick with the content, the yield shift in property is going to be a little bit difficult to adjust to, because we've had such a long period of declines in the market that now we are expecting a moving out.
So Hans, what are the key drivers of this yield widening that you expect?
Yeah. Well, I think you already sort of alluded to bond yields. I think we are seeing quite a lot of interesting things happening at the moment in the economy and in bond yields. So if we look at the economy first, we're really seeing a continued recovery in the economy coming through. It's spreading throughout Europe. Okay, we have some political issues still rambling around. Of course, there's Brexit, there's the Italian budget issues that are being dealt with. There's a lot of different things going on, but apart from that noise, I would say that the recovery is continuing. Okay, it's not speeding up, it's maybe taking a little bit of a breather, but it is still spreading across Europe, and that is effectively making it possible for central banks to start considering taking away the quantitative easing that they put in place when the global financial crisis started. And that was massively reducing the bond yields. Bond yields have also come to historical lows. More recently, we've seen some of the markets going out again, not just Italy, but also some of the other markets. And we think that trend, and in fact, we are looking at the forecast for bond yields for the next 5 years to go up by about 200 basis points, on average across most of the European markets. Now, that bond yield widening, we think, is going to also push out property yields as well.
Yeah. Okay, that's super interesting. But how can you investigate the impact of this on like individual markets?
Yeah.
Where we're interested in?
Many of our clients and also ourselves, we think that bond yields and property yields are not perfectly aligned. There's a lot of things in between. So we've come up with a new approach, a risk-adjusted approach. And so we're looking at risk-adjusted returns in a new analytical framework where we compare two things. We're looking at the expected rate of return and the required rate of return. Now, the report does a good job, going into the full detail of how these returns are built up, different elements of it. We are using, of course, the latest scientific methods, as you have introduced to us as well. But the comparison is really straightforward. Expected versus required rate of return, and then of course it's quite simple that if the expected rate of return is ahead of the required rate of return, we think that is an attractive market. And then there's of course the reverse, then it's less attractive, and there's a neutral category as well, which we sort of think that okay, our method is maybe not that precise and we should have a neutral category as well. But for all of the 90 segments that we have on coverage in this approach, we make that determination. In fact, the selection of the 90 markets is entirely based on the availability of sufficient historical data so that we can actually do that backtesting. We do need to do that backtesting to make sure that, as you say, the methodology actually gives the right signals, that it gives the results that we would expect, And so we have done that backtesting back to 2007. And if you look at the results from that, and we've indexed those results where we do effectively an index based on the number of markets that are either attractive or unattractive, and then we look at the balance between those markets. And if you look at those results in aggregate, you're seeing sort of a low index score, i.e. not a lot of markets are attractive straight going into the global financial crisis. Okay, so that makes some sense, that's the right signal. And then as the financial crisis emerges and prices go down, for new investors, because we always assume that you invest at a certain point in time for a 5-year period, at the prices after the global financial crisis, obviously it was going to be more attractive to invest. And the methodology shows that quite clearly. So yes, we have done the back testing. Yes, it does seem like the approach works, and therefore we can feel comfortable that the results that we have are relevant. Yeah.
Okay, so what do the top line results show? Are there any sectorial differences that you can explain?
Yeah. So the top line result is effectively that we have 51 out of the 90 markets that are classified as either attractive or neutral. So that's 51 out of 90. If you then look at the different property types, there are some clear trends there as well. Actually, they fit pretty closely to the consensus view, I think. Not that that was something that we were shooting for, but we see that the high street retail markets actually in today's results have come down a little bit quicker, a little bit further than the other segments. And we're seeing, for example, logistics. Logistics is showing still a slightly better result. It's also definitely come down, even though it's still, of course, everybody's favorite sector. It's come down from where it was 2-3 years ago. And so we do see some differences in the different sectors. Logistics and high street retail being the two, the sort of two extremes in that respect.
Yeah, that's very interesting. I will come back later to the late cycle stage, but for now, can you elaborate a little bit more on like individual market results, like who are the under and overperformers?
Yeah. Well, of course, for each of the, as I said before, we have for each of the 90 markets, we have this comparison. So for each of the 90 markets, we can look and see if they are attractive or less attractive. There are a number of outliers in the results that are maybe worth highlighting. And the advantage really of the approach is that it's not only showing the outliers, but it's also allowing you to see why they're outliers. Because you have two elements. You can always look back into the expected and the required rate of return. What is triggering the result, And so if we look at some of the outliers, Berlin office and Glasgow office are very obvious, outlier results. In the case of Berlin, that's really tied to the fact that the demand for space is very strong. We have high-tech companies still moving to Berlin. It's a very affordable market. People can live there and have good jobs and places to live. We also see the government sector still moving to Berlin as well. The supply reaction in that market is a bit muted because the government is perhaps a little bit slow in giving the permissions. And so for Berlin, we're seeing a very strong rental growth, and we have a good, solid, expected rate of return. And on the required rate of return, the German bond yields are still some of the lowest in Europe, and the other risk premiums on top is also being quite modest. So the required rate of return is also quite modest. On the other extreme, if we look sort of at the less positive outliers, there are markets like, for example, Dublin offices, where the market has already realized a lot of rental growth. Now we're seeing the new supply coming in. That new supply, in our view, will have the impact that rents will be coming down from where they are today over the 5-year period. So it's always about the 5-year period. It's about the timing of where supply and demand are, and it also looks at the required rate of return. And by using this approach, we can pick apart the results and explain why we have these different outliers.
Okay, let's stick with these less attractive markets as you described them. Should we not invest in them, or should we still invest in them? Can you elaborate a little bit more on that?
Yeah, I mean, we've gotten this question from quite a few clients. Our approach is really looking at a prime market result. And so it's basically assuming that you are investing in a prime property. Now, when you look at this definition, it's quite precise and narrow, but in the market there are a lot of different deals that are available to investors.
Mm-hmm.
And so we would point out that it would be a little bit silly to not invest in markets because the overall market, the overall prime market signal is perhaps less attractive because you still have a wide range of different deals. And we've done a bit of work on the RCA data. We love working with the RCA data, and it's showing when you look at the initial yields, for example, for deals across the 90 segments over the last 12 months, you see a nice sort of broad distribution of deals, and that means that there are still attractive opportunities available, even in markets that are perhaps qualified as less attractive. So we think it'd be unwise to sort of not keep looking in some of these less attractive markets because you might have to look a little bit harder, but there's still attractive enough deals available.
Very interesting point, this distribution. But let's switch gears and come back to the late stage. Like, can you indicate what the downsides are currently and how they compare with the previous cycle?
Yeah, so in that case, and of course, if you've been through a few cycles like myself, you are sort of starting to pick up some common themes. One of the things that has triggered previous down cycles is the excessive new supply of space. And so if we look at that at the moment, now we still have a lot of data issues in Europe, but if we are looking at, for example, offices across Europe, we can see that the supply pipeline of new buildings is picking up a little bit. But if you measure it as a percentage of existing stock, and more particularly if we accept the fact that we are now in the late cycle, which our approach clearly indicates, if we compare the current late cycle for the next 5 years, this new supply is definitely a lot lower than what we saw in the previous late cycle 5-year period. In fact, it's about half. Now there's a number of different reasons for that. One of the reasons is actually that developers are finding it much more difficult this time to get financing from banks in particular for speculative new development. Mm-hmm. And so I think that is actually a very good feature of where we are in the market today. This new supply is much more limited, and we do expect this to be similar in especially on the logistics and also on the retail side, even though we don't have the full data set to support it.
Okay, great. There's another point I want to focus on, and that's debt. Like debt has been very important in the last cycle. Can you elaborate a little bit more on how the debt looks in the current cycle at the late stage?
Yeah, I mean, I think this is actually another point to sort of focus on when you look at the limited downside going forward. I already mentioned this link with the new supply, but if you actually make the point in a more general term, if you look at the system-wide debt that is encumbering the real estate sector, we actually are seeing a very positive trend in that space, because if you look at data from EPRA and from INREV, EPRA is looking at the REITs and INREV is looking at funds, you're seeing a decline in loan-to-value ratio for both of those parts of the market. And that means that the level of debt that is supported by current property values is a lot lower than it was in the late cycle in 2007 and 8. And I think that is a much better starting point. If we are going into a late cycle, if we need to adjust, the chances of people not being able to refinance, perhaps having to extend the loan terms, I think that risk is a lot less at the present time based on the data that we have available. So that's quite a positive thing as well.
Okay, Hans, thank you very much for that, for answering these questions. Do you have any concluding remarks?
Well, just thank you for all your hard work, and of course the team in Paris as well for putting the report together. It's been a lot of fun. It's also been a lot of hard work. We already are receiving some questions from clients. We would welcome client questions, of course, always. We find them very interesting. And so we look forward to hearing from our clients and answering any questions they might have. Thanks very much.